Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome, everybody. I'm Jeff Barton. I'm your host for The Mortgage Voice, and we're on each and every week. Thanks for tuning in. You know, we are available on podcasts, all kinds of podcasts. Daryl, what are some of the podcasts that we're on now?
Oh, we're on iHeart, and we're on iTunes, and we're on Spreaker, and we're on all those good ones.
Right, they call them the Big Eight, right? Isn't that what it is?
Yeah, I just named half of them, I think.
Yes, very good. So if you are out there and you're listening to us either via radio or on podcast, thanks for tuning in. We're, of course, with KCAA, KMET, and K-Tahoe, three great radio stations that we've been affiliated with for a number of years. So if you're a regular, thanks for tuning in. If you're somebody who's new and wants to see the show, because we do shoot this for those two radio stations here in the Inland Empire, Riverside, San Bernardino counties, and you can go to their websites and see us, or go to our YouTube channel, Jeff Barton, The Mortgage Voice, and this show, as well as many, many other shows, pop up, and you can see us. Make sure two things. One, leave us a bit of a description of what you think of the show, kind of a review. You like it, you don't like it, what you do, what you don't like. And also, if you are there, click on the, what's the bell there?
Subscribe button and the bell.
Subscribe button and the bell. The subscribe gets you plugged into what we're doing, and the bell alerts you to the newest show available. So both those things can help you stay abreast of what we're doing, and what we're doing is trying to keep you informed of what's happening in the mortgage market. So thanks very much again for listening, and again, I'm Jeff Barton. A lot of things going on in the news over the past couple of weeks. As you know, we had the impeachment up and down, and we had State of the Union up and down, and we certainly had the Iowa caucus, which turned into it's just a mess. I mean, it's typical of why Democrats are having a tough time here in 2020. What did you?
Mayor Pete.
Oh, he's the winner?
He's the winner.
Oh.
Mayor Pete.
Oh, very good. I don't know whether that's very good, but yeah, sure. Why not? Why not him? You know, why not us? I mean, anyway, so all these things are going on. And meanwhile, I think the most important news that is not talked about is mortgage rates. I'm just going to tease you a little bit. I'm going to mention them a lot more in a future segment. But just to let you know, in the world of interest rates, it's good to be a mortgage today. And this is written by Matthew Graham, who, by the way, is, I guess he's the CEO or president or the director over there at Mortgage Daily News, the website that we get all our information from every week for the show. He's a really good guy, and he was able to write this article, and he says, basically, the Treasury's mortgage rates tend to move in the same direction by generally similar amounts because mortgage rates are based on underlying bonds, the mortgage-backed securities. Okay, 30-year fixed rate hasn't been this low since the 2016 lows. That's over 3 years, almost going into 4 years. This is the lowest rates they've been. 30-year fixed rate today is 3.375 to 3.5%, which means, of course, that if you're out there and looking for a house, you know that the prices of houses have gone up. They just have everywhere, and I don't care what state you're in, I don't care what county you're in, what area in what county you're in, the prices are just higher. And they look to be going a little bit higher this month. But with these interest rates, every time you lower the interest rates, you obviously, the dollars that you have stretch a little further and be able to buy a bit more. And with house prices going up, maybe there's a bit of a equalization in that. And I think there is. So get out there, look around. There are some opportunities in the marketplace. Certainly, if not in Southern California, perhaps like, 30,000 people a month who are moving to Las Vegas from California. These are the type of things that you can take advantage of there because the average home price in, I think, Vegas finally topped $300,000. Now, of course, here in Southern California, $300,000 doesn't buy you a closet. But there, you can get a place. You can get a house, or you can get a condo, or you can get, any number of things on the market, townhouse or such. Certainly off strip, you don't want to be anywhere near that anyway. It's kind of loud and tough to get around. But if you get out into the outer communities, and there are a bunch of them, it's really nice. Henderson's great, and I really like that. But I think your dollars, how they stretch, and what you're looking to buy, really aided by this really super low interest rate, and also certainly to get out there into that market because I think the prices are lower. Okay, so let's see. I saw a show. Do you watch TV much, Daryl?
Some things. I watch Jeopardy.
Okay. Excellent. Very nice by Alex. He doesn't look good.
No, he doesn't. But the questions are either getting easier or I'm getting smarter. I don't know which.
Well, yeah, I think it's probably the latter. You get smarter when you get older.
Yeah, I watch some of the quote-unquote reality shows.
Okay. I watched this show on, it's either Prime or HBO, Netflix, one of these, called Jack Ryan. You know the famous character from the Tom Clancy novels?
Yeah, I've heard of it, have not seen the show.
Okay, they made a bunch of movies. Harrison Ford played this character. One of the Baldwin brothers played it way back when with the Hunt for Red October. Now I'm dating myself, right? That's back in the 90s. But I'm watching this show, and why I bring it up is because I think it relates to the mortgage market a little bit. The show is about expectations of what we think when we think about the conflict between certain people in the Mideast and the West. The central character, aside from Jack Ryan, is this Arab who he was denied employment in a bunch of U.S. firms, got angry, went back home, and started a revolution. I mean, that's essentially the plot of it. And intertwined in all this is, people dying, of course, and people, just acting as if you would expect any kind of exploitation of people to act. It's an interesting series, and if you like action and that sort of thing, and you disregard all the underlining messages of the film, this kind of, and why I bring it up is because what we understand about people, about mortgages, about expectations of the marketplace or of people who are in the marketplace are fixed a lot of times. I want to go through in the next section that we're going to go through reasons why people don't get mortgages. And you have in your head what you think is the requirement to get the mortgage. Yet, what really happens is there's a problem with your thinking because the obvious, okay, my credit score is terrible. Well, I can tell you the credit scores don't matter as much as they used to. Okay, I don't make enough money. Well, a lot of the loans that were considered why we got into the recession in 2008 are back in the marketplace. They just don't call them subprime mortgages anymore, but they are back, and I'll explain. Also, some of the things that you can do to stop, negative credit and to stop a lender looking at you as if you aren't capable of repaying that loan. The expectations of what you have in your head completely different than the reality of, can I get a loan? What's it going to cost me? And what are the parameters and the restrictions and the requirements? Very simple stuff. Also in the news, what I like to say is the future of the mortgage market. Now, I don't know. Did you watch the Super Bowl, Daryl?
I watched maybe the last quarter.
Okay. There was a great ad in the Super Bowl for independent mortgage brokers. And now somebody spent some bucks, right? Mortgage broker had an ad. And it was this little kid. He was on a skateboard laying down, and he had a rocket strapped to his back. Now, everybody knows where this is going, right? Rocket mortgage. So the thing didn't work, and the kid was not upset, and he was rolling around, and the caption to the whole commercial is like, when you're trying to get a loan, what you need is a professional. You don't need gizmos and gadgets. And I think the future of what's going to happen in the mortgage marketplace is still open to conjecture, but I think it's more of a mix, and I want to get into that a little bit later in the show, too. Hey, I'm Jeff Barton. I'm your voice in the mortgage industry. I really appreciate you listening to today's show, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton. I'm your host and voice for The Mortgage Voice, and we're on each and every week. KCAA, KMET, and K-Tahoe. Great radio stations that bring our show to many, many people on Saturday, Sunday, and Thursday. We're on 4 or 5 times a week, and you can catch us both on the radio live, or you can go to every one of those radio stations. Our program is archived. We're also on a blog. Oh, no, we're not on a blog. We're on a podcast, several of them. What are some of the ones? I can never remember them all.
Spreaker, iTunes, iHeartRadio,
right,
amongst others.
Yeah, and you know what? I actually go to iHeartRadio myself. Spreaker's one that I don't really visit. That's more of a younger trending. But if you're looking for podcasts, The Mortgage Voice, Jeff Barton, The Mortgage Voice, you can catch it on all those particular places that you can catch the show. Also, if you wanted to see the show, we shoot the show every week for TV, for KCAA and KMET. They carry a feed for the show. You can go to YouTube, Jeff Barton, The Mortgage Voice, and you will see this and many other shows on there. And you know what? Click the bell. The bell will alert you as to when the next show is available. And also, we need reviews. We need reviews. Why? Because we like to put the show into a higher gear, i.e., what you think we should be doing, what you don't like about the show, what you do like about the show, we adjust. We can make it what it is. However, most of the things that we do talk about on the show occur in the mortgage market. So if we're saying it, it's not because we're making it up. We're reading it on a number of websites that we go to try to check out what's happening in the news. Many things affects the rates, no question, but the plenty or the amount of money in the marketplace now and then, really the last 5 or 10 years. And that's because, and everybody, we talk about it all the time, the Fed has now, obviously, since September, begun to fund or buy mortgage-backed securities as well as treasuries, what they call the non-QE QE. QE was the quantified easing program that was instituted, maybe 5 years ago, and it was a way by which liquidity could return to the market and stabilize rates. Well, the market has really gotten used to that, and because of the fact that we've had some issues with what happens in the overnight, the Fed lends money overnight to banks to make sure that they have enough money in their accounts to satisfy the net worth requirements or the liquidity requirements in order to be in business. There are 5 large institutions that they've labeled cannot go bust, so they have to lend them the money. So what would happen? I guess before September, August, September, the funds in that account to lend out ran short. So member banks would then supply the money, but they would up the rate. So if you're borrowing money from the Fed at 2.25%, money runs out, and a member bank puts money in there, but they want to lend it to you at 10%, well, that's an issue, right? Obviously, nobody's going to want to be able to do that. So in order to solve the problem, the Fed jumped in and said, okay, we will reinstitute, although they didn't call it, QE. And what they started to do was buy, I think it was $60 billion a month of treasuries, mortgage-backed securities, which, again, is putting everybody back on free and loose money. I mean, the one thing we don't hear anymore is deficits. That deficit meter is, I don't know, have you seen the deficit meter and how it grows every day by trillions of dollars? Well, not trillions, but billions of dollars?
No, I've seen the death clock or whatever it is.
No, that's a whole different thing, like the DEFCON 5 clock, we're 2 minutes from midnight.
2 minutes from midnight.
Right, exactly.
Minute and a half now.
Yeah, sure, I know. And then they roll the clocks back. I know how that works.
No, I did not know about the other one.
Well, the debt meter is huge because every year, $1 trillion during this administration, the presidential administration. They don't talk about it. What they want to talk about is cutting taxes and how great the economy is doing because everybody's employed. What the problem is that these types of deficits are going to kill us in the long run because eventually we're going to get into a recession. We're not going to be able to pay for things. My own personal opinion is this is a long-term strategy to get rid of entitlements. Entitlements are what? Social Security, Medicare, welfare, anything that is personal welfare, not corporate welfare. No, we're never getting rid of that. Personal welfare, yeah, that's what I think this overall strategy for years has been, whether it's Democrat or Republican, and I think what will happen because basically both sides of the aisle are kind of tied up in the corporate politics world, whether you're Burisma hiring Joe Biden's son, or whether you're Donald Trump, not giving up his taxes because he doesn't want to show that he's got hotel interests in every country that has currently got sway with him, whether it be Turkey or Russia or you name the country that is currently out there that we used to never be friends with, that we are now. The reason is because the president's got some interest there. But either side, it's the same thing, and that's why I think, and where it's headed. I don't think it's a good thing, but nevertheless. Okay, let's talk about 5 weird reasons you won't get a mortgage. We talked about it quickly in the first segment of the show. I want to, Daryl, let me ask you a question.
Yes,
what do
sir.
you think would be the number one reason why people can't get a mortgage?
Don't like your face. No.
No, that's number 7. Sorry,
Okay.
that's
No, it's got to be affordability.
no. It's according to this article, and again, these are weird reasons, right? Not the top reasons.
Okay.
The 5 weird reasons. Okay, this one, which is true, it's not so weird, but when you're switching from an employee to self-employed, that's
Okay.
what I mean by that is
Makes it look like you ran out of money.
well, they don't like it because it's not consistent. If you're an employee, i.e. you get a W-2 at the end of the year and you file your taxes online, easy file or whatever you do, that's great. If you have 2 years history of that, that's your income and that's what you can borrow on. However, if you decide you're tired of working at that $12 an hour job and you want to go out and get your own company going and then you start making money through your own company, those 2 years, 1 year it this way, W-2, and 1 year it the other way, 1099, or however you do your own particular personal income tax, whether it's Sub S or C Corp, they don't like that. So in a situation like that, maybe you have great credit, maybe you're 750 credit, but if they look at employment history like that, they're going to kick you out to the non-QM world. Now, is that so bad? Not really, because you could probably get a non-QM loan right today at 4.25%, 30-year fixed, maybe 10% down. So it's not a bad deal. However, you're not going to get that smoking 3.375 rate or 3.5% rate because you don't have the Fannie Freddie in a box type history and loan that they like to see. And I think that's one of the issues that they're talking about. Number 2 would be failing to balance your checkbook. What does that mean? That means you fall behind on your bills and maybe they've tagged your credit a little bit. You don't want to do that. It's a weird reason, but at the same time, it does affect your credit. And as everybody knows, last couple of weeks we've been talking about how credit is being viewed today versus historically, and we talked about it last year because this was the way that credit scoring and the way lenders looked at credit was going to go. They're going to look at 24 months. How have you been doing your last 24 months? Well, if you're somebody who can't balance a checkbook, you probably can't pay your bills on time. Now, if you're doing that consistently, that's going to hurt your chance of getting a loan. Number 3 on that list, applying for new credit and opening an account during the loan process.
We've talked about that a lot.
Oh my gosh, I can't tell you how that's the craziest thing. We had somebody just the other day who decided to buy a car when they were trying to get a home loan. Well, needless to say, they're no longer getting a home loan because you can't place that kind of financial stress on a monthly, which is a 5-year car note, at whatever it is, $300 to $500, that's just going to kill your ability to borrow. And it's going to kill your debt to income ratios, and it's just don't do it. Okay, number 4, ignoring small bills. We touched upon this a little bit about balancing your checkbook. And number 5, not filing your tax returns. I can't tell you, even if you don't make money, you have to file your returns. It's one of the things in the 4506. That's a form you fill out in order to give the lender the opportunity to look at your tax returns. If you don't file, you're not going to get the best loan, and you may not get a loan at all, even if it doesn't matter because you didn't make any money that year. Filing is king. Those are my top 5 weird reasons you won't get a mortgage. I'm Jeff Barton, your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. If you want to see us, if you want to hear us, tune in each and every week. We're Friday and Saturday. You can also hear us on our podcast. We are on Apple, iHeart, Spreaker, any number of different podcasts around. We're in the top 8 podcasts nationally, as well as, of course, KCAA, KMET, and K-Tahoe, 3 great radio stations that broadcast the show each and every week. If you go to those particular stations, you can see us. If you want to go to YouTube, we've got a great YouTube channel. It is The Mortgage Voice, Jeff Barton, The Mortgage Voice. If you give us a review, we'll love it. If you hit the bell button, you will get, notifications of when we're going to be on next. We bring great guests, we bring great information, and you know what? I really want to hear from you. So please, sign up for what we have, and then we can bring you these great shows each and every week, and at your leisure if you go over to YouTube. We bring back to the show somebody I have been wanting to get back on, but we had some internal issues at Malibu, and that's the company that sponsors the show. Now that they're cleared out of the way, we look to have Wendy Van Wessel on much more, and she's from Stearns Lending. Wendy, how are you?
I'm just fine, Jeff. Thank you for inviting me.
Thank you very much for coming back on the show. So how are you? How you been? And how's business?
Good. 2020 is looking really good. The rates are staying low, so the refis are still real popular.
Yep. I saw that 9 million people can take advantage of rates this low. 9 million refis should be happening this year. That's a lot of refis.
And they should. If they're in ARMs, if they have a higher rate, why not save in your monthly payments? With the rate so low, why not pay off your high credit card interest rate to a lower fixed rate over 30 years?
Now, when you guys are looking at credit risk, we talked a little bit earlier about some of the problems that people have, some of the weird or reasons that people won't get a mortgage. What are some of the things that Stearns looks for in their underwriting guidelines in order to ensure that people can get a loan?
Well, we're looking to see that people know how to make payments. I mean, we'll even do loans for people that have no FICO score. That's called non-traditional credit, when they have a history of making payments on time, their cell phone, their car payments. We can do loans for people like that because they've proven, although they don't have a FICO score, that they know how to make payments on time. And that's all a lender's really looking for in the history. You've always put the information in what we call the black box, the automated underwriting system, but they're looking for reserves, they're looking for FICO scores, and they're looking for history of payments.
Okay, in the history of payments, that's also about credit, right? I mean, I heard that they are changing the entire process of how they're looking at credit. Is Stearns involved with that too in terms of their underwriting?
The entire process of how they're looking at credit, I have not heard that yet, but I will definitely look into it for you and tell you exactly what I can find out. I will find out for you.
Yeah, they're talking about looking at revolving credit as opposed to a snapshot of where you were 12 years ago, like the last 24 months of payments. Like you said earlier, have you been paying your bills on time? Are you somebody that can make a commitment to either a car payment or rent or any number of other things in order to be able to prove that, yeah, you can pay your bills on time?
Well, you sure. I mean, the credit that we look at now, you can have with extenuating circumstances.
Sure.
Instead of waiting 7 years after a BK, you can do it in 4. And with the non-QM programs that are out there, you can do it after 2 years of foreclosure and or a BK 7.
What is happening with the non-QM world in Stearns? Have you got some interesting products that may be of benefit to some of the listeners today?
Certainly. You know how sometimes when we have self-employed businesses, we write off everything so we pay less taxes? Well, that's not really conducive to getting a loan. So what we offer is 12 months worth of bank statements or 24 months worth of bank statements for your business or your personal side if you pay yourself from your business without all the write-offs. So you can still qualify for a loan. That's one of the programs we offer. We're also going to get the non-owner-occupied home stack where if it pays for itself with the rental income that you get,
Right.
then you don't have to have any income or anything else. That's the loan. The property is paying for itself on a non-owner-occupied property.
Now, that's an interesting loan, and I've noticed that there are a couple of other lenders doing something similar. Is that a product by which I guess your investors are interested in purchasing because of the fact that the rental income, even if there's no tenant in there currently because you haven't bought the house, is that something that is, I guess, in demand? Because obviously it would have to be in order to offer these kind of products.
Yeah, remember before the whole thing fell apart when people had 6 and 7 non-owner-occupied properties
Yep.
and they refinanced them because they would just be able to pull money out of them because the values were going up, and all of a sudden it went upside down and they went from owning 5 and 6 properties to nothing. I think a lender looks at the non-owner-occupied properties that are paying for themselves, that even if they did default, this is a property that has a lot of equity, that has a good stance in the area for what kind of income it can produce. So that's why the non-QM purchasers are willing to do it that way.
Okay, and what you're saying then is there is I guess, an investment that the buyer has to make. How much down or how much into the property do they have to have?
Non-owner-occupied properties are usually 80%, but sometimes we can get a little higher, but they're usually looking for you to have some skin in the game.
Right, no, I mean, you mean 20%, not 80%, right? I mean,
That's 80% LTV, 20% down.
I
sorry.
see, right. Well, that's still pretty
Sorry about
low. I mean, when you're thinking about it, because traditionally a 20% down would be, you know, a type of conventional loan that you'd be doing for a 30-year fixed. I mean, that was always the way people would look at properties, I mean, historically. So if someone right?
That's what my parents saved up there for when they bought their home. That's certainly right. But we can do 97%, whether it is 96.4 on the FHA side or 97% on the Freddie Mac Home One. Even Fannie Mae can go to 97% now.
What are the most popular programs that you're currently dealing with? You guys must be busy as well.
Yes, we are. And I'd say the accelerator program for people who have an 80% or less, and they have a wage earner or they're salaried, and they own only that subject property, those prices for us as far as rates go, and I know we're not allowed to quote rates, but they're very, very good. They're the strongest in the industry right now. So that's real popular with us. I'd also say that our piggyback seconds are very, very popular, where you have a first. You can do it to 765, 600 in the Los Angeles area, and you can follow it if it's an 85% HCLTV. With $500,000, so that's a $1.2 million loan. And if you don't pull from your second for a month, then you do not have what we call a CLTV hit, so that extra adjustment in the loan for having that second with it.
I see. Very interesting and very obviously. And how many people take advantage of a product like that?
A lot of people.
A lot
of people. They're waiting to reduce, to spruce up their house or to pay off their credit cards because they don't have to pay it off straight away. A month later that they do it, it's a 10-year IO HELOC too.
Okay, let's talk a little bit about what's happening regulatory-wise. There's a lawsuit currently wending its way to the Supreme Court. They're supposed to hear it in April. It's about the CFPB and the legality of the CFPB, the way it's currently configured, and also whether they're going to do away with that particular department at all. In regulatory world, I think the lenders like the CFPB and they like it. Consumer-wise, I'm not sure whether they're getting the best products out there. What's your opinion on this?
I don't think the lenders like it necessarily.
Okay.
I mean, there was an audit that we had done years ago when they first came out, and they only fined us $2 million because we were a really good company. And we did a really good job. So I don't think the lenders like them too much. What kind of government entity that only makes money through fines is a good idea?
And that's why I asked you the question, because I knew you'd give it to me with both barrels. I happen to agree with that. No, I do. I really do. I mean, if it's anything worse than that, you probably get it here in California. As you know, AB 5 is a new law that's come out that determines whether you're an independent contractor or whether you are a W-2 employee. It's, again, yet another attempt at a money grab here in California. We already have trouble trying to qualify people with the amount of money that they do make, but more taxes taking out means that people can afford less property. What's your feeling on that?
Well, we have ways around it, too, because we
Yeah.
offer a program called Imagine. We're one of 2 lenders out there that offer this program, and it is Freddie Mac that puts the MI on the loan after the loan closes. So normal lender-paid MI, so that the mortgage insurance doesn't get included in your debt-to-income calculations.
Oh, that's great.
It's a lot higher than what Freddie does with Imagine.
That's excellent. You know, Wendy, we're up against the clock. That was fast. Next time we're going to have to do a little more. You there?
Sure.
Okay,
I'd love
excellent. All right, this is Wendy Van Wessel from Stearns Lending. Wendy, thanks very much for coming on the show. I really appreciate it.
Have a wonderful day. Thanks, Jeff.
And you too. And I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton. I'm your voice in the mortgage industry. If you want to see us, if you want to hear us, we would love to hear from you. We have a website. We have a terrific YouTube channel. And, of course, you can hear us on KCAA, KMET, and K-Tahoe, 3 great radio stations on the weekends and during the week. And we would love to hear from you. Also, if you go to our website, go to YouTube, Jeff Barton, the Mortgage Voice, and you can see us there. Sign up, give us a review, click on the bell button so that you can be alerted to each and every new show that comes on. We are also an iPod. We are just smoking on iPod. If you go to Spreaker or iHeartRadio or iTunes, what's the new name for iTunes again, you said?
It's going to be
I just know it's iMusic. I thought it was iMusic.
Is that
or Apple Podcasts.
Oh, Apple Podcasts. Anyway, if you're any of these terrific places where you can locate podcasts, yes, we too. Jeff Barton, the Mortgage Voice. And I appreciate you listening. I appreciate you coming on each and every week and seeing what we have next for you. And the voice you hear is not the voice of who you might think. It's Jennifer Conrad, a great contributor, constant contributor to the show. She joins us from Malibu Funding. Jennifer, how are you?
I'm doing well, Jeff. Thank you for having me.
And thank you very much. Okay, give us a little bit of a 411. What's happening out there in the mortgage world aside from unbelievable rates again?
Well, I'm going to tell you, recently I've been doing a bit more of the FHA 203K loans. We have the ability to do the FHA rehab loan and also the VA rehab loan.
Okay,
So,
tell us about both of those. Tell us what they are and how it works.
Well, actually, with FHA or VA, a borrower has an opportunity to actually do a purchase, maybe with a home that when they first go in and they look at it, they feel like there need to be some upgrades. It's not everything that they want, but maybe they're getting a good price for it. This gives them an opportunity with minimum down payment. FHA is 3.5%. With the VA, it's 100% financing. And what we can do is allow them to actually do improvements up to 97.75% of what the final value is going to be, or 100% of what the final value is going to be on a VA loan.
Wow.
So it's a great opportunity. They do ask that, obviously we keep the foundation. We don't do anything regarding, messing with the structure of the foundation. And pretty much if you have one wall standing, other than that, you could pretty much, if you wanted to, redo the entire house. So as long as we're within, obviously what is considered a fair value, once we're actually done with all of the completion. You do have to do appraisals.
Right.
And I can do that FHA one down to a 550 credit score, but it has a little bit more stipulations. You can only go to 90% of the value, but if I have a 580 credit score or better, then I can do the full 97.5%.
This is an amazing loan. So what you're saying is then I see this fixer that I want to buy, and I want to get a 100% loan. I'm a veteran, and I'm looking at this, and it's within the parameters of the amount of money that the VA will lend me, but they'll lend me on what it will be once I fix it up, not what it is today.
That is correct.
Wow. That's
correct. And it allows you to be able to, sort of build your dream home. Sometimes you
Right.
don't find exactly what it is you want when you're going out looking, but if you can make certain upgrades and it's within, what the final value is going to be, then it gives you an opportunity to be able to have it. And you are allowed 6 months to be able to get the work done. It requires, a bit more footwork because we have to have a licensed contractor. They have to be state licensed. We need to be able to have a profile for them. They need to be able to provide references of other clients that they've done work for.
I see.
They have to carry all the standard, insurance, bonds,
course.
all of that. But
How is the money?
outside of that?
How is the money released? How do they do that? Do they do it on an inspection, or do they put it in escrow and you go?
They have inspections, and then
I
they
see.
are allowed to have up to 5 draws.
I see. Now, how much? So, do you have to front the money? How does that work, really? I mean, I know.
No, actually, the borrower can fill out a form that is considered a hardship form,
Okay.
which allows for the builder to get up to 50% for the cost of materials only, not for labor, up front. And then after that, they would have draws based upon every time they've, had a certain amount that they've completed,
Right.
and then they go back out, do an inspection to make sure that that's done.
Now, once you get this type of loan, this is your finished loan, right? There is no more, like when you get a construction loan, you have to end that construction loan and then go get a mortgage. This is kind of an all-in-one product.
It is. It is an all-in-one product. I'm sorry, Jeff, you probably heard my son get
Hi.
in the car and make a comment about one of his fellow schoolmates just threw a football that almost hit the car. So
Oh, my, I didn't hear a thing.
I'm still getting in the car.
All right, let's touch on that. You're a mom. You're a working mom. What is it that you can bring to a mortgage of a couple or people who have children or children in high school that maybe somebody else can't bring? What kind of, I guess, understanding of circumstances that people maybe gives you an edge over somebody who just doesn't have that experience?
I think one thing is, as a single mom, I'm always pretty conservative about, where my funds are going and making sure that I am projecting for the future for my son. So I think with a lot of people in the industry, they might try to stretch people who are looking to purchase and maybe sometimes stretch them outside of their budget. I try to be very conservative about that and sort of look at other people purchasing a home or refinancing their home as if I were doing it myself. So
Right.
I think I take it from a standpoint of, obviously wanting to give them whatever it is that I would do for myself, and in some cases better, than I have done for myself in the past. So I think that. I think, being a parent, a lot of times we have to approach things from a very creative standpoint, so we sort of have to keep our eyes open to so many different things. That being the case, when I carry that over into mortgages, I think a lot of times that I try to make sure that I'm aware of different opportunities that I can make available to homeowners that maybe some other loan officers might not think about, because they'll just do a straight conforming loan and that's it. So they don't look into, do we have lenders that'll help with down payment assistance programs, and
Right.
Do we have like the rehab loans, or do we have even people, I've talked to you about this before, foreign national people who are coming in who are wanting to purchase. So I try to make sure that I sort of keep my eyes open and ears open, and try to gain as much information as I can. So by working with me, you have a loan officer who will hopefully be able to help you with like a primary residence. But if you need to come back later and say, hey, I need to take out some money, to try to put my kid in school, then I can help you out with that. If you ever decide you want to buy investment property or second home, or if you have family members who are, in another country who are not part of, the U.S. as a citizen, but they want to purchase here, then I can help them with a foreign national loan as well.
That's interesting. Let's talk a little bit about that. In terms of a foreign national, somebody who's not a citizen here, give us the top 6 things that they're going to need in order to be able to get a loan?
For one thing, they definitely need to be in good standing with their country. So I need a CPA letter saying you're in good standing. I need
Okay.
a bank reference letter. letting me know how much money you have in that account. I need to have some sort of utility bill showing me that you currently own a primary residence and that you're paying your utilities there. I need to make sure that you are with a bank that's going to allow you to transfer funds over, and it's not a loan that is something you're going to have if, finances are, incredibly tight, because in some cases, if we do an appraisal and then we come back and it's negative rent, if we're showing that for whatever reason the rental amount is going to be, less than what the actual mortgage payment is going to be, then we need to know that you have the reserves to be able to show that, which is the amount of the rent times 12 months.
Excellent information.
That, visa and passport.
Right.
You know?
Yeah, I do. Hey, listen, we're running up against the clock. I want to give people the opportunity to get in touch with you, either by phone call or email. If you could provide that, that'd be great.
Sure. My number is 773-593-6831, or you can send me an email at jcprocessing@gmail.com.
Excellent. Jennifer Conrad from Malibu Funding, thanks very much for once again coming on. Great information, Jennifer, and thanks very much.
Thank you, Jeff.
Thank you very much. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks for tuning in. Thanks for listening to us each and every week. Our iPod, I can't even talk. What is it called? The podcast? Yes, it is.
Yeah, they're podcasts.
Okay.
Apple Podcast and others.
Thank you very much.
Would you like to know some of the others?
Yes, I would. I'd like to know all the places you can hear this show.
Apple Podcast, Google Music Play, Spotify, Spreaker, Stitcher, iHeartMedia, Radio.com.
Well, that's pretty good. That's about the only places I think you can actually find this kind of show.
This is where people look the most.
Exactly right. So if you're out there and you're listening to my voice, you can go to these places and hear this on any device, your phone, your computer, your laptop, your iPad, your whatever it is that you've got, you can hear it. And we do appreciate it. If you want to leave us a review, we'd like that even more. We like a little bit of back and forth with the listening audience to get us to know what's happening out there in the mortgage marketplace in terms of what information you want to hear, what information you want to be able to, provide for you and your family. Also, if you go to YouTube, we have a YouTube channel. This show we shoot for TV, so it's there, as well as all the great guests. You can take a piece, listen to the whole thing. We've got archived hundreds of shows there. It's Jeff Barton, the Mortgage Voice on YouTube. That's our channel, and we really appreciate it if you can go there. We do have a website. What is our website? It's called themortgagevoice.com?
Mortgagevoice.com. Right.
Okay, excellent. Very good. So all these different places you can see the show. KCAA, KMET, and K-Tahoe are the three great radio stations. And again, we've been doing this for a number of years. Really happy with some of the shows that we do. Some of the shows are more informative. Some are topical. Today's show is no different. And I wanted to get to the rates right away. But thanking you, San Bernardino and Riverside counties, and everybody up in Tahoe who listen to the show, who get information. We're here to try to help. We're not here to promote us as we're the best, come to us. No, that's just not what we do. We do think we are good. We do think we can provide terrific service at Malibu Funding, and they're the great people who provide funding for the show and sponsor it each and every week. I, Jeff Barton, am the host and the voice for the show, but that's the company that pays for everything, so I want to give them a shout out as well. Okay, the rates. Let's look at the rates because, as I said in an earlier segment, haven't been this low since 2016. Now, in 2016, they were as low as they've ever been. And we're talking, as I said then, 30-year fixed rate, 3.375 to 3.5%. Now, that is a smoking deal. You're not going to find one better unless you go to a different level of product, an ARM product, a 15-year. Speaking of the ARM product, 5-1 ARMs right now at 3.25% to 3.75%. So there's a bit of an overlap. It's a little bit lower if you have terrific credit, if you've got ability to repay. As you know, these ARM products adjust after 5 years, but with the Fed buying the way they've been buying, and maybe they will continue for the next 4 years, especially if we've got Donald Trump as our president, he seems to be able to berate the Fed into maintaining their current interest rate bias, as well as, buying or mortgage-backed securities and treasuries in the new QE and whatever that is, QE4, I guess we would call it. There's some funny names for it. If you want to understand what I'm talking about, go and Google QE question mark, and you'll come up with a bunch of different funny names that they've got for this. They're not calling it that. They're calling it a temporary, I forget the term, but it's typical Fed speak, right? Do you remember what it was?
Quantitative easing.
Yes, that's what the QE is, but I mean, in terms of what they're calling this new thing, which is really QE, but they're calling it something else. It's an adjustment of something and something. Anytime you want to go to sleep real early, read the minutes of the last Federal Open Market Committee meeting. We just had one, by the way, and they had rates remain the same. We've been so tied up with all the things going on in the news that I think a lot of people get distracted and kind of forget what's happening and what's real in their lives. But if you're there and you're looking at buying a house, I'm telling you, the rates are great. The FHA VA is 3.125%. It's almost at 3 flat. That's amazing at 97.5%. Even with the MIP that they stick on at 1.25% on a yearly, it's only going to jump your mortgage rate up to maybe 3.375, 3.5. That's really, really nice. And especially when you have the insurance behind you, you're only putting 3.5% down, and you don't really need FICO score. I mean, I think in an earlier segment, I forget who was talking about it, maybe Wendy, you can have a FICO score of 500 with FHA. They can get you a loan. There are some lender overlays with that, and your rate may be higher. But in terms of getting a rate based on what your FICO score is, as we've always been told, if your FICO score is great, your rate will be great. If it's not great, it won't be great. FHA, they will do down to 500, and that is not great. But you can get a loan. So that's a pretty good option for you. 15-year. Now, when I got my 15-year fixed, we were paying 5.125%. I was happy with it. You know why? Because regular rates were 6.5%. Today's 15-year, and this is an average going across the country, as we say each and every week, you could probably get this, call in, but right now, today, according to this particular article written by Matt Graham, and he's over there at Mortgage News Daily, you can get a 15-year fixed rate 15-year fixed rate, not ARM, 3.125% at 3.25%. Wow, that's pretty smoking. The difference between what I had and what this is 2 full points. And everybody knows it's $100 a point per 100,000. So on a $400,000 loan, those 2 point difference would be $800 a month different in terms of what you'd have to pay. That's a pretty good deal. I mean, when you're looking at paying and what you can pay versus what you can borrow, 2 different numbers. You want to borrow the most, pay the least. The least you can pay, the more you can borrow. And that's really how you have to look at the rate, because if they're taking it from you in the rate, you can't purchase that house that you want to purchase. And with real estate prices being what they are, going up, albeit not hugely fast, but inventory is low. So if we're talking spring buying season starting in March, April, May, well, you're probably going to see a larger or a greater jump in those particular rates. Those particular prices for real estate. Okay. Came across a couple of interesting articles, and I'll get right to it. I said earlier that they had 9 million borrowers. Millions of borrowers can save big on mortgage finance as rates have hit their lowest level in more than 3 years. The average rate on a 30-year fixed rate mortgage just hit 3.49%. This is the average rate according to this article. About 9.4 million borrowers could save an average of $272 a month if they were to refinance right now. So if you bought a house 2 years ago at, let's say 4.5%, you could lower that rate by almost a full point. You could definitely save $300-400 per month. That's a big deal. And you've only spent 1 year, maybe 2 years in interest payments, so you could make up that probably pretty quickly. And again, there are tables and there are things online. Call a mortgage broker, call a mortgage banker, call somebody who's in the business. They'll be able to run these numbers very quickly for you and tell you how long it's going to be before you regain that lost interest payments that you've been making. But the amount of money that you're going to save over the next 30 years is going to be huge, especially if you can drop your rate by a full point. That's a smoking deal. Lenders plan to find and retain customers. How they plan to do that? Okay, right now the number one channel, what they call channel, well, the number one thing that is out there is the mortgage broker or mortgage loan officer's personal contact list, i.e. their referral list. That's the number one thing that's driving business in today's market. Number one. Now, let me see. What is the percentage here? Okay, when questioned about channels, the most frequent response cited by 67% of the respondents was that the loan officer is the most important thing in the transaction in terms of driving business. That's amazing. But in future business, and I don't know if this is a wish or if this is a reality, but they say that that is going to diminish. And the reason it's going to diminish, and this is for anybody who works today, if your job can be eliminated by automation, AI, or any number of other ways, they're going to do it. Because the loan officer makes money. And that's the number one factor why the lender or the bank or the mortgage banker, they want to get rid of the loan officer or marginalize the amount of money they can make. Because they're the biggest expense in the mortgage industry is paying people. Man, that's unbelievable. I'm going to leave it at that. I'm Jeff Barton. I'm your voice in the mortgage industry. Thanks for tuning in this week, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.